You're watching Dukascopy TV. I'm Elaine Stenson and I'm joined in the studio now by Francois Nordhof, who's First Vice President with BCP Bank here in Geneva. Today we're going to be looking at emerging worlds and industrialized economies. Francois, you're very welcome.
Hello.
Can you start by telling me today, how is BCP exposed?
Yes, within our client portfolios we have an emerging bias in terms of investments due to the fact that we are not only a wealth management company but we are also a trade finance company. We need to be exposed to those countries, and it's true that currently, despite the current troubles within the emerging world, we are exposed to those those countries and to these regions, and more specifically we're exposed within fixed income, mainly fixed income, and there within the asset class, I would say we have also a bias towards corporate bonds instead of sovereign bonds. Those bonds are mainly denominated in hard currency, means US dollar, euro, sterling, Swiss francs.
And how can we evaluate the current economic environment between emerging markets and industrialized world?
Yeah, the current situation is actually investors were mostly blindly investing in emerging markets, saying, anyway, the problems are within the industrial countries. The thing is that currently there is an economic rebound within the industrialized region, which to a certain extent was not expected by investors or not by professional investors, but it is currently happening. Have a look what is currently happening in the US. The real estate market is recovering. The interest rate situation within the US Treasury bill market is changing. Interest rates are rising. Also, central bank, the Fed, is currently saying to investors, be aware about one thing: tapering means that a less accommodative monetary policy will occur, maybe not in 2014, it's maybe going to be in 2015, but they say it publicly. This is changing. Also in Europe, 6 months ago, who could have believed that even France, which is actually the worst case for investors because everybody has fears regarding the France economy, saying, but the French economy is going to fall into recession, as it was the case for the South European countries like Italy, Spain, Portugal and Greece. And what are the first signs that we see in this summer? No, industrial production is stabilizing in France, even to a certain extent recovering. We see even that in France some sensible reforms like the pension fund reforms, which has just been decided now, is going to be implemented. Therefore, investors from overnight, more or less, started in end of June, July and August, started to say, the advantage of being invested in emerging countries are going to decline compared to the weaknesses which were occurred for instance, in Europe or even in the US. Therefore, there was a massive shift from investors from emerging region to industrialized regions, which is to a certain extent an excess.
And how can we make the distinction between the previous emerging crisis and the current economic situation in those countries today?
Yeah, the problem is that currently investors and there are not too many because most investors are still underexposed in emerging countries, were thinking back to history and saying, but these types of crises, we faced it already in the late 90s, in 96, 97, where we had the Asia crisis or the Latin America crisis. And the situation is completely different from that time. At first, not the same countries are facing new problems. Currently, the problems within the emerging countries are focusing on or concentrating on very specific countries. Turkey is, for instance, one of those countries. Brazil is one of those countries. India is one of those countries. But the remaining countries, nobody is speaking, for instance, about Thailand. Thailand was one of the problematic countries end of the 90s. It's no more the case. I would not say it's the best case, but it's not the weakest member within Asia, by far not. And also even India or even Turkey, which are problematic cases now, they have good signs. There is good. Indeed, those countries have current account deficits, but those current account deficits are at least not facing a huge external debt as it was previously the case. We see that there are even some structural strength in those countries. I mean, the India of 1991, which was the India who requested the help of the International Monetary Fund, is no more the same country today. They have an industrial network, they have a financial network, they progressed massively, and therefore investors should make indeed the distinction between several countries, but they should also make the distinction between the previous crisis, which was a much more severe crisis than the one that we have now. Even most emerging countries facing problems today have still an economic growth, which was not the case in 1996 and 1997.
Okay. And how can investors know how to position themselves in this very difficult financial market environment?
You can imagine risk-averse investors are mostly bringing back their investments into Europe and the US, or even to a certain extent Japan, for the less risk-averse one. But in the emerging country, they need to be very careful. They are going to be underexposed. And this financial market has increased. It means that, technically speaking, investors are making a negative bet against the market, or a financial market, who is becoming even more important over time. Because over time, we know emerging economies are going to grow. Means financial markets within the emerging markets are continue going to grow. Therefore, they need to be exposed. And currently, we would advise very carefully to increase and to benefit from the current correction within the bond market in order to invest in corporate bonds, in Asian, Latin American corporate bonds, or Eastern Europe corporate bonds. Why? Because those corporate bonds at first are yielding quite high. You have a high-yielding bond, you have a high-yielding investment, and you have a high-yielding tenor, maturity. It means you are not going to block your money for 10 years. Those companies are companies which are just able to enter financial markets in hard currency with a short maturities. It's exactly what investors should look to. They need to look to short maturing bonds, not to block their money for 10, 15, 20 years. No, they should invest with a time horizon of 3 to 5 years. You find bonds and you find corporate bonds. Then moreover, keep in mind, in Europe, we still have a weakening of the credit ratings, also within the corporate bonds in Europe, also in the US. Corporate bond issued in industrialized countries are going to have a downgrade of their ratings, more or less, in the next 6 months, 18 months, for sure. Where in the emerging world, it's exactly the opposite. The credit ratings of those companies is going to improve. And that's a very, very nice point for investors. Therefore, we advise corporate bonds, and we advise for more risky clients also to invest in emerging equities, but to be more careful, not to buy it by individual names, to buy funds, diversified funds, investing in a global emerging market, and not only the one that is investing in India or the one that is investing in Mexico, but at least a fund that is investing either in a region, in a full region, or globally. There we have a corporate governance issue. It's very difficult out of London, out of Geneva, out of New York, out of Tokyo and Singapore to control really the management of an emerging company when you are an equity investor.
Okay. And what are the fresh concerns for investors in emerging market regions?
Okay, what are the point that an investor should look at? For instance, I mentioned corporate governance.
Yes.
Corporate governance, indeed, companies are less equity or shareholder friendly, that's for sure. And corporate governance are less developed than in the States, than in Europe, than in Japan. And investors should be aware about a few things. It's not because if you buy a bond of a company that is close to the local authorities, that you are going to be more protected. And here, for instance, in this specific case, we may maybe tell about a very simple story, which is a very small, it was not a big case, it's a small case. It's a Russian company owned by the state of Russia, involved in the aircraft industry, which is a very sensitive industry because it's targeting also public transportation, but also defense sector, who decided overnight to go in default with his bond. Means they decided not to pay the coupon and not to redeem the principal at maturity. This company is fully owned by the Russian state. Indeed, it is not the state of Russia, but it's fully owned. You see, therefore, investors, when they are going to invest in bonds, they should not simply say, I want a bond that is, for instance, as close as possible to local authorities in order to be protected, because this is not enough. They need to understand much more the business model of the company in which they are investing. And for that reason, indeed, as an investor, we are looking, for instance, mainly to companies that are either, for instance, if they are selling consumer staple products or manufacturing consumer staple products that are, for instance, have a nice market share into their own local population, or that the economy of the local economy is growing, or that the needs of the local population is going to change, and that this company is going to benefit of it, or that there is only any other relative advantage, like a price advantage, a production advantage, or whatever. That's what investors should take care about it, and not just about stories and rumors.
Thank you, Francois. And that's all we have time for now, but do check back later for further updates and interviews from the Dukascopy TV team. Bye for now.